Hello students, welcome back to next episode of Mastery in Commerce. In continuation to the previous topic, today we will be starting with the numericals of accounting for partnership basic concepts. In the numericals, the first thing which is given to you in the chapter is the difference between fixed and fluctuating capital. Illustration 1 we will be doing, but before that I would like to see the tabular form of the difference between fixed and fluctuating capital. We will see their format and then we will be moving ahead. So over here we can see the difference between fixed and fluctuating capital. There are the points which are given for the basis. Then one column is of fixed capital and fluctuating capital. Even in your theory question, this kind of tabular representation will be very helpful. On the basis, the first point is number of accounts. In the fixed capital method, we have two accounts, capital account and current account. In fluctuating capital, we prepare only one account, that is capital account. So all the transactions, whether it is interest on drawing, interest on capital, salary, commission, everything will be written in the capital account itself. But in the fixed capital method, the capital account will show only the capital balance or one or two things related to capital. All the other transactions, expenses or profits will be written in current account. We will see the numerical, then it will be more clearer to you. Change of balance. The balance of fixed capital account remains unchanged except when there is addition or withdrawal, which is I told you in capital account we don't change the amounts. But in fluctuating capital account, things keep on changing from time to time because all the expenses and profits we are recording in the capital account only. What kind of transactions are recorded in fixed capital? In the current account, we record all the interest on capital, salary, commission. And in fluctuating capital, these all things are recorded in the capital account itself. Can a capital account show negative balance? In fixed capital account, partners capital account can never show negative balance. But in fluctuating capital method, the partners capital account can show negative balance. Now over here, we have the format of both capital account and current account. In the capital account, you can see under the fixed capital method, when the amount is brought down or when we carry forward the balance of the capital, it is written on the credit side. As we all know, capital account has the credit balance. So the balance when we are bringing it down, it comes to the credit side. If there is any amount given of introduction of new capital, then it will be written again on the credit side. If any amount is withdrawn from the capital for the office use, that will be written on the debit side. Please remember, the withdrawal of amount for the office use is written, not personal. Personal is drawings. So drawings will not be recorded in the capital account. If any interest on drawing or drawing account is there, will be recorded in the current account. Okay, so over here this bank account on the debit side actually represents withdrawal of capital for office use. Then we will find the balance. If nothing is given, if in the question nothing is mentioned about introduction of new capital or withdrawal of amount, then the capital account balance will remain the same as it is brought forward. No other thing will be recorded in the capital account. Everything related to other transactions will be recorded in the current account. So with capital account, we prepare another account, that is current account. Current account balance, if it is given in the question, then that will be written according to what side they have given you, debit or credit. Any one side the balance will be brought down. Then all the now this current account we are preparing for the partners. So remember the same rule, all the incomes of the partners, means whatever money they are receiving will be written on the credit side, and whatever payment the partners are doing to the firm will be recorded on the debit side. Please remember this, because PL appropriation account, when later we will be studying, it is made for the firm. So we will see from the firm's perspective, but current account we are seeing from partners perspective. So if partners are earning something, they will be recording on the credit side. If partners are paying something or any expenses they are doing, will be recorded on the debit side. Now on the credit side, you can see salary, interest on capital, PL appropriation account, whatever balance we have got. If profit is there, then it will come on the credit side. If PL appropriation account, any loss we are getting will come on the debit side. Then drawing, interest on drawing, because these are paid to the firm by the partners, so it is written on the debit side. Then we will calculate the balance. This is very important to remember, that this we are seeing from the partner's perspective. Over here we are seeing the format of capital account, which will be prepared under the fluctuating method. In the fluctuating method, the capital balance again will be represented according to the question what it is given to you. Then all the drawings, interest on drawing, PL account for loss will come on the debit side. If any fresh capital is introduced, will be written on the credit side. All the incomes over there, salaries, interest on capital. You can see actually this capital account is the combination of current account and capital account. Okay, so whatever we learned in the fixed capital method, that is clubbed together in the fluctuating method. So this method combines both the accounts. Only one account is prepared, that is capital account. Now I request you all to please see in your textbook the question. I have not put the question over here in the slide because the question is already there in your textbook. In the question, it is told to you that partners have the capital of 15 lakh and 10 lakh. They agreed to share profit in 3:2. These are the main things I am reading from your question. Additional capital is introduced for 3 lakh and 2 lakh. Then interest on capital is there, then drawings, then interest on drawings, salary, commission, share in profit for the year. That is also given in the question. So the thing which will come in the under fixed capital method in the capital account is the balance which is given to you. See in the starting, the first line 15 lakh and 10 lakh, we have written balance brought down 15 lakh, 10 lakh. Then it is also told to you in the box you see in the table which is given in the book, additional capital is introduced as 3 lakh and 2 lakh. So that will also be recorded on the credit side bank account. Okay, what is the journal entry whenever capital is introduced? Journal entry is bank account debit to capital. So over here both the partners are bringing additional capital. So bank will be written in the capital account. Bank account debit 3 lakh and 2 lakh. Now, as no withdrawal for the office or nothing is given in the question, so nothing to write on the debit side, we will just add both the items written on the credit side. That will be our capital, the balance of the capital account. So it comes to 18 lakh and 12 lakh. Now we have seen that capital account will not show the other transactions, but the other adjustments or transactions which are given in the question, like drawings, interest on drawings, then the profit, share of profit is given, then interest on capital, then salary, commission. These all things will be shown in the current account. You can see now interest on capital calculation. I will tell you, it is there in the next slide how we have calculated. First, you can see the salary is only for Samir, so it will be written under Samir's account. Commission is given to both the partners, so commission is written for both the partners. Then drawings is also written in the current account itself for Sameer and Yasmin both. Interest on drawings is 1800 and 1200 for Sameer and Yasmin. PL account, the share of profit which is given in the question is given to both the partners. And then normally as we used to find in the ledger account in grade 11, the same way balance is taken for current account. And the balance is 24,450 for Sameer and 3300 for Yasmin. So first of all, I'll show you the working notes for the calculation of interest on capital. Now please notice over here that how the interest on capital is calculated. This is not very tricky because in final accounts also you used to calculate the interest on capital by taking into account the dates which are mentioned over there. In your question, it is mentioned that once the capital is introduced in the starting of the year, it means for that capital we will be charging interest for entire year. But additional capital is also introduced, which is introduced in the month of October, 1st October. So it means on that it should be charged for 6 months only. So when on 15 lakh you are calculating interest on capital, it will be 75,000 because for whole year we are doing. Then on 3 lakh we will be doing only for 6 months. And what is the way of doing it? 5 upon 100 into 6 upon 12 into 3 lakh. So it comes 7500, and we have to add both the amounts that will give us the interest for the entire year. Same we will do for the other partner as well, Yasmin. It is 10 lakh for 1 year, 5%, then 50,000, then 2 lakh for 6 months for 5, it's 5,000. Same way, and we will add both the interest on capitals, it comes 55,000. So you can see in the previous slide, you can go to the previous slide and see once that this 82,500 and 55,000 are written on the credit side of the partner's current account. So this is how the calculation of interest on capital is done. So this explains to us how the fixed capital method is maintained by the partners, in which two accounts are prepared. Capital account, in which no transactions are recorded. Current account, in which all the transactions are recorded but capital balance is not shown. Capital balance will be shown only in the capital account. So this is the another method. The same question we will see, that how partners capital account is prepared. In this, now whatever opening balance of capital was given to you is written on the credit side, balance brought down, which is 15 lakh and 10 lakh. Then additional capital which was brought, you can see under the heading with bank we have written 3 lakh and 2 lakh. Then other transactions which were recorded in the current account are all recorded in the partners capital account only. Means we are not preparing any separate account. We have written interest on capital, salary, commission on the credit side, then drawing interest on drawing, PL account all in the debit side. So then as usual we the calculation of balance we do the same way we will do the calculation over here. So partners capital account is bringing together both capital account and current account. So this fluctuating method is usually followed in all the questions. Until and unless it is not specifically mentioned that partners are maintaining the fixed capital accounts, we will follow fluctuating method only. So please revise this question, and you can do the unsolved question 1 which is there in your book. In that also they have asked you to prepare the capital accounts when the capital is fixed. So first question is about fixed capital method, that you can try after understanding this question. If you have any difficulty, please leave a message in the comment box. If you like this video, please like, share and subscribe it. Understanding it is very easy once you do it yourself. So please try doing yourself also. We will meet again in the next video with the next numerical. Bye for now.